When it comes to business tax, it's really not a one-size-fits-all kind of deal. In fact, the government has some very specific and, honestly, sometimes surprising rules for different industries. Today, we're going to crack open the Income Tax Ordinance and see exactly how it handles everything from giant cargo ships to brand new apartment buildings. So, why the different treatment? It's a great question, isn't it? And the answer, well, it tells you a whole lot about how the government thinks about different parts of the economy. By the time we're done with this explainer, you'll definitely see the method behind what might seem like madness. All right, let's get into it. Here's our roadmap for today. We're going to kick things off with shipping, then we'll tackle profit on debt, move into the world of real estate, and then cover a really fascinating concept called deemed income. To wrap it all up, we'll look at the key definitions that make everything click. So first up on our tour, the massive world of international shipping. Now, how a shipping company gets taxed all comes down to one simple question. Is it based here in Pakistan or not? Section 7 and 7A lay out two totally different playbooks. Okay, now this is where things get really interesting. See, a non-resident company is taxed on its gross revenue, basically what it earns from its operations in Pakistan. Simple enough. But for a resident company, the government throws that rulebook out the window. It's not about what you earn. It's a tax based on the actual physical size of your ship, its tonnage. This is a huge shift from taxing profits to taxing capacity, which for the government can be a much more stable and predictable way to get revenue. And here's the actual text from the law itself. Don't worry, no need to squint and read all the fine print, just look at the highlighted parts. Over on the left, for non-residents, you see that key phrase, gross amount received. It's all about the money they make. Now look to the right for the residents. The language is completely different. Per ton of gross registered tonnage per annum. That's the legal foundation for these two very different ways of doing things we just talked about. All right, let's switch gears completely. Now we're talking about a totally different kind of income, the profit you make from debt. Think interest on a loan, or maybe returns from an investment. Section 7B gives us a really clear rule for how this gets taxed. So what's the big takeaway here? This tax is for individuals, not for companies, and it's super direct. You just take the gross profit you received, apply the tax rate, and that's it. No complicated deductions, nothing fancy, just a straightforward tax on the total amount you earned. But, and this is a huge but, there's a critical number to remember. This specific rule only kicks in if your profit on debt is 5 million rupees or less. The second you earn more than that, well, this whole tax section no longer applies, and suddenly you're playing by a different set of rules. Okay, on to a massive part of the economy, real estate. The government has cooked up a really specialized tax system just for builders and developers, and it's broken down into a few key sections that we're about to walk through right now. Now, you'd think it would all be about the final sale price, right? Well, nope. The logic here is actually super physical, very down to earth. The law first asks, okay, are you a builder selling a whole building, or are you a developer selling a piece of land? Then it bases your tax on the physical size of what you're selling, the square footage or the square yardage. But wait, that's not the whole story. A more recent rule, Section 7F, comes in and adds another layer to this. So on top of that area-based tax, there's now also a tax on the overall taxable profit from these activities. It brings a whole new focus on earnings into the mix. This table lays it all out for us. And here's the kicker. We're not talking about your actual profit, what's left after all your costs. The law basically says, nope, we're just going to decide your taxable profit is a fixed percentage of your total sales. For builders, it's 10% of whatever they bring in. For developers, it's 15%. And if you do a bit of both, it lands right in the middle at 12%. All right, brace yourselves because this next concept, it's a little bit of a mind bender. It's called deemed income. This is basically where the government can say that you've earned income just by owning something, even if you haven't sold it, haven't rented it out, or received a single rupee from it. So here's the core rule of Section 7E. A resident person is considered or deemed to have earned income that's equal to 5% of the market value of the capital assets they own in Pakistan. It's basically a tax on the value of just holding on to certain properties. Now, of course, before you panic, there are a ton of exceptions here. This tax doesn't apply to your one main asset, for example. It also doesn't apply to your own business premises or agricultural land that you farm yourself. There are also important exclusions for assets given to the families of martyrs, and maybe the most important one for most people,
If the total value of all your assets is under 25 million rupees, then this section doesn't apply to you at all.
So, to really make sense of all these rules, you have to get into the nitty-gritty, the specific language of the law. I mean, the definitions of these key terms are absolutely crucial. Let's look at a couple of quick examples. So, what exactly is a capital asset when we're talking about this deemed income tax? Well, the law defines it very broadly. It's basically any kind of property. But it also carves out some really important exceptions. It doesn't include the stuff a business uses day to day, like its inventory, raw materials, or equipment that's already being depreciated for tax purposes.
And check this out for an example of just how specific the law can get. A farmhouse isn't just, a house on a farm. For tax law, it has to meet very specific size requirements. The plot has to be at least 2,000 square yards, and the house itself has to have a covered area of at least 5,000 square feet. This kind of tiny detail really matters when you're figuring out what's exempt and what's not.
So after going through shipping and debt and real estate, what's the big picture here? What's the one thing tying all of this together? It's that all of these sections show a really clear trend. The tax code is moving away from broad, general rules and heading towards highly specialized, laser-focused regulations for specific industries. And that really leaves us with a big, important question to chew on. This kind of specialized tax law might be more targeted, sure, but it also becomes way more complex. So how do we, as a country and as individual taxpayers, strike that perfect balance between making things fair and just keeping things simple enough to understand? That's the real challenge that these laws bring to the table.